Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, May 29th, 2020. It's about 12:38 p.m. as I'm starting this video, and I wanted to go over some trade ideas. We'll start out here. What I'm going to do is just show you real quick this one. We're on SOXX. This is the semiconductor sector ETF, because some of the trade ideas that I have on here in this video, and these are mostly trade setups. It's a big difference. So, I'm talking about on QQQ, for example, on those FANG stocks. I put out the charts today. Said earlier this week, and I addressed this to some comment on the front page today, that in order to get those drops, which we didn't get, and we're probably not going to get this week. I'm talking about the breakdowns in QQQ and the indexes, and those FANG stocks dropping. You need to get the sell signals, and we don't have that yet. QQQ is still well above this is the blue trend line, the same trend line I had before. I just colored it up. We need to see that go, and then of course on all the market leading FANG stocks, again, it's the blue lines that I showed you today. So I gave you the check marks. Only 2 of the 5 had check marks, and those check marks are always, they're questionable until the majority of the FANG stocks break down, not just 1 or 2. And also you want to see the sector itself go, or the index, QQQ. So you have Apple and Microsoft. They are the 2 biggest, so that's certainly worth noting. They broke down, they back tested, so technically they're on sell signals, but not the type of sell signal you want to take. Given the resiliency of the uptrend, you need to see some of those near-term levels go. I'm going to add one right there. I see a little bit of support that will most likely come into play. So that's what we need to see. So we had check marks there, but again, not on the rest. Amazon, like I said, we did have the breakdown on the daily chart. If you missed that recently, you had, zoom out here, bearish engulfing candlestick with 4 confirming red candles. That's about as good as it gets. But again, is Amazon going to drop? Is that going to be a lasting top or a significant top, which a bearish engulfing candle after an extended run indicates? That's what you want to look for. Yeah, I think so, but I can tell you it won't, and I'll be wrong if the rest of the market, the FANG stocks don't break down, because Amazon's not going to drop 10, 20, 30% unless Alphabet, Microsoft, Apple all drop, roughly that or somewhat. And it's just because the indexing there, it's all one big machine. They are top components of the S&P 500 and QQQ. And it's the money flows in and out of the market, in and out of those instruments, and all the S&P 500 index funds, and your 401k and IRA and everything else. So money flows in, is going to lift the stocks, and there's been a lot of articles on that in recent years. That's it. So because of that heavy indexing, it is possible, but unlikely to see a big drop in Amazon with Apple and Microsoft and all the others continuing to go up. So that's it. Just want to mention that on Amazon, although we don't have a check mark on the 60-minute, we do have that daily, pretty bearish action there. But again, that kind of seals the deal, I think, a break below 2280. And then Alphabet, walking the line right now. That's a few dips intra-period, not as solid. I say you want to see a solid 60-minute close below to really give you a sell signal, and that's not it. Those are just a little whipsaw, just really trading right on the trend line, really is what that is. And then Facebook too, very close. So we're not going to get those, the big drops this week, but we're precariously perched right above all these support levels, and that only takes not even one bad day, just a half bad day. 1% down on most of these FANGs will have taken them through there, and then it's quite likely, because these are fairly well-defined levels, that you're going to see, some sell orders kick in, stops get hit on longs. But until then, and again, I can't be clear enough about this, no breakdown, no sell signal. These are just trade setups, or really in this case more things to watch for the market. All right, I'm going to jump in and give you the trade ideas. Let's go back to SOXX, because that's the semiconductor index. QQQ is all about tech. Semiconductors are a subsector of the technology sector, and really kind of the canary in the coal mine for the tech sector. Probably this board. Let me color this line up here. I have 2 lines. I'm going to color them both up. We already have 241.20 on this chart. This is a 60-minute chart, by the way, guys. And so here's a rising wedge, like a lot of the stocks in Nasdaq 100, a lot of stocks in general. And most importantly is a trend line. The upper lines are the divergence lines, which also form a wedge. And again, we continue to diverge. So this is what we're looking at. Since you have a trend line in the 241.20 support level below, that's what I call the BOD, or benefit of the doubt level. You want to see 241.20 go with conviction. This line up here is a gap right here. I'm going to show it to you on a daily chart. There's a big old gap back here. Actually, that's more significant, and that is a gap from the 21st of February until Monday. And we had the gap down on Monday the 24th. It's a big gap, a lot of stocks and sectors. I've covered this in recent videos this week. There are numerous sectors and key stocks that have these comparable gaps. That's really what kicked off the party to this whole big drop, the bear market. There was a bear market there, and we peaked in February, kind of started moving down a little bit, and it's these gaps that were kind of like a wake-up call. That was a big, very big gap, technically significant. We back tested it the next day in SOXX and never looked back. We tried a little kickback rally, never made it all the way back there. Just that one initial test of the gap the next day, the bottom of the gap, and bottom fell out. So it's technically significant. Does it guarantee we fail there? No. Do I think we do? Yeah. Well, these are key levels, and again, there's a lot in the charts, divergences, everything else. And what happened is the semis entered the gap. They tried on several occasions to backfill it. They got about halfway through, and so far have been unable to. So while I cannot call this a rejection off resistance, because that would be bearish to see a test and then a rejection, a failed attempt. Rejection means you start clearly moving lower, especially impulsive. But we could, that's what I'm looking for. So I'm laying out these videos, things to look for. There's the uptrend line in SOXX right now. We had one there and it broke and had a little correction and moved up. So pretty much red candles that would take us below this trend line and down below that gap after failing to surmount it. Even maybe we walk up next week, hit the top of the gap. That would be your next resistance level once you're in the gap. But even to get inside of a gap and then fail to fill it, backfill it, and start moving lower impulsively, that in itself is pretty bearish, because once a gap is entered from above, it is usually backfilled. Not hard and set rule, but typically it is. And so a failure to for the buyers or the bulls, whatever you want to call them, to push it up there and make a full backfill. And so far that's been the case. See that several attempts. But as I like to say, resistance is resistance until unless taken out, and support is support until unless taken out. So we're kind of pinched between both. That's it. Nothing else to add to that other than watch for an impulsive rejection. That's what I favor, and that's what the bearish case wants to see, because I have I'm net short the market, and bulls want to see that, and that wouldn't be good. And that's time to start covering positions. And by the way, I have quite a bit of cash, because the market is this is a time I think it's a good time to scale in, because of a lot of stocks and sectors and even the indexes up against significant resistance, divergences in place. But to go to an aggressive or all-in short, and all-in, by the way, and I probably should address this, but in another video, I see comments occasionally on the site, people losing thousands of dollars, tens of thousands of dollars shorting the SPY. Again, I don't know where you shorted or wherever, but on the last official trade on the site, which was stopped out, gosh, I can't remember. I have to tally it up. What was it, an 8% or so loss? One position in your account, if you lose 8%, should not have a material impact on your portfolio. Any one position should represent one of a dozen or more positions, and so again, sometimes I have to speak to that, because I use these terms like an aggressive, or all in means all in to the extent that you want to be long or short a sector or an index, it's all goes back to asset allocation. Portfolio should be, you should have a pie there, and let me make a little pie. This is what a portfolio should look like. And proper asset allocation, diversification. Asset allocation means how much you're going to have in stocks, how much in bonds, commodities, gold, Bitcoin, if that's what you want. Those are different asset classes, maybe Forex currency. And then you also have your security selection. Are you going to be short the markets? So, how much of that? Are you going to have some longs as well? Very often, I'll have both longs and shorts. Long the most bullish stocks, short the most bearish. And there's also cash. Cash is a big component too. In other words, you should never have 100% of your portfolio in any one stock or any one sector or all in gold. That's just insane, and that's where you're going to lose if you have a position go against you 5, 6, 8, 10%. And now you should have a plan ahead. Said that would be my maximum loss. That should not have a material impact on your overall portfolio. It should be one of many positions that got stopped out. So let's move on and go over the trade ideas. Okay, what I did today is went through a lot of the components, not all of them, but a lot of them in both the Nasdaq 100 and the IWM, the Russell 2000 small cap index, because we do have an official, as of yesterday, an official short trade on the small caps. I'm going to just get the two, the charts that stood out as either clearly bullish or clearly bearish. A lot didn't. I didn't have an opinion, but there were two that look potentially bullish, and I should share those. WBA, Walgreens Boots Alliance. Positive divergence down here, pretty good positive divergence on the daily time frame. That's not a buy signal, but it is an indication of a likely trend reversal, just like was pointed out back at the time. Positive divergence right here, bullish falling wedge, breakout, and a nice rally to trade. Same back here, bullish divergence right here at this point, and that was a breakout there. So we have the divergence, but your buy signal will come. It's not the best defined trend line, but it's fairly well defined. Just one little false whipsaw through it, and that would be your line. Now, weekly chart is not so hot to me. Plus, my views on the market, so I will tell you right now, at least at this point in time, I'm watching this one. I don't have a position. May look to do that. So you have this divergence forming on the weekly. It would be nice if you could see this one at pretty solid support. There is some support here, so I'm pointing it out because to me it is one of the best looking, most attractive long opportunities from a risk reward profile. So I think if the market, rallies from here over the next 6 months or the remainder of the year, this one certainly has a chance to outperform. And let's leave it there. That is some support, by the way, on this weekly chart, about 36.75. It would help to see this PPO turn up and turn up soon. Two things: stock should hold that support, start moving up, break out on the daily time frame I just showed you, and turn back up the PPO here. Now you can take a position here. I'll either take stocks on one of two ways if I'm going long on a breakout of resistance, in this case a trend line. You also have, you probably can't see it there, the 50-day moving average has done a pretty good job of capping this downtrend. It's a yellow line, very subtle in here. I have the color turned down, but we're right there. So I'll pop above the 50-day, a solid break in that trend line. Or the other way I like to go long, it's objective, is pullbacks to support, and that's what you have here on the weekly chart. I didn't catch it last 2 weeks ago, but that's where that was. And the other one I mentioned was KHC. Oh, actually, I'm sorry. I mentioned this several weeks back, quite a bit. I was updating and said it was one of the better looking longs. And it's broken out. I mentioned it back here in this below the downtrend line, below the 40-week moving average. That's the red line there. It does a good job of saying, hey, when we're trading above the 40-week, the red line, we're in a bull market. When we cross down below, as we did here, we're in a bear market, bear market, bear market, bear market, bear market, bear market, boom, breakout, bull market. Or at least that trend indicator, if you will, has flipped to bullish. We also took out the trend line. Big, strong, divergent low. As I said, a few weeks back, one of my, better looking longs, in my opinion. They had earnings on April 30th, pointed out, and the earnings are out of the way now, and there it is. You had a breakout, a back test, and it's been inching higher. Nothing big since it broke out of the downtrend line. Where are we? About 7%, but it's a dividend-paying stock as well. I think if that's the accurate dividend, about 5.25% dividend yield. So there's those are my two top picks that I saw going through. Again, some but not all the components of the Nasdaq 100. Okay, so if your glass half full, those are the two I have for you. Now, if you are on the dark side, then I'm going to go over some of the shorts that stood out. I already covered the semis and what to look for there. I think I did. Did I tell you? I know I started there, but did I make clear that, yeah, the benefit of the doubt line right there, 241.20, and everything else you need to see, and there's some levels. All right, so some individuals, I'll just follow up with the one I mentioned the other day, was NVIDIA. NVIDIA had this island cluster top right here. That is a cluster of candlesticks separated on two sides by a gap. down below. Gap 1 here, and then we gap down right there. We came in, we backfilled the gap, but were rejected. I had mentioned that as a shorting up anywhere from here. The day after, still objective with a, an ideal stop would be anywhere probably like about 2/3 up of the way the candle, a little more than halfway. I think that halfway point is where maybe a lot of the algos will sniff out the stops. And what's nice about these is these are major topping patterns. They're not just a quick pullback trade, one and done. They can mark a major top quite often. And so what that means is the risk reward is phenomenal. If you shorted, you shorted in the last couple of days, and you have a stop loss up here, let's say somewhere around there, you're looking at less than 6% downside. And if this one revisits, let's just say comes and tests that low again from March, 46% downside. That is a phenomenal risk reward ratio, and that's how I would trade that, because it is a topping pattern, potential topping pattern. So if 6% is above your comfort level for a loss, well, the way around that is take a smaller position size. If you normally short $10,000 in a stock, or go long any position size, then do 5,000, and then a 6% stop loss is effectively you're only losing as much as you would on a regular trade that you put in and allowed for a 6% stop loss. You're looking, as a 3% stop loss. Again, in this market, if you're trading tech stocks and things like this, 3% is just way too tight in my opinion. These stocks are volatile. They go up and down 3, 4, 5% in a day. So again, everyone has to have their own trading style, and to me, 8, 10, I'll take a 20% stop loss allowance if I'm shooting for an 80, 100% return on an aggressive trade with a very bullish chart. It's all relative again to the risk reward ratio. How much money are you risking to make X amount of profit? And then of course, if I were to do that, I'm going to reduce my position size down, because if I'm trying to make 80%, 100% on a stock or long-term trade, and I'm going to allow a 20% stop loss, well, I'll take a much smaller position, because if I make my profit target, then I'm making as much or more money than I would have on a normal trade that I was only targeting, say 10 or 20%, that had a much smaller stop loss. So those are the considerations to keep in mind, and from time to time I like to bring that up, especially when I see people talking about huge dollar losses, and it's all relative too. Some guy or gal's $10,000-$20,000 loss might mean a lot less to them if they've got a couple $1,000,000 to the person that's only got $10,000 and lost 1,000. So everything is relative. But just back to NVIDIA, still objective, still, backfilled, several attempts to try to regain the gap, and still objective right there. And again, the odds will increase substantially on this and all these short trade ideas I'm showing you here, if and when the Nasdaq 100 and the majority of those market-leading FANG stocks break down. Next up, another component of the Nasdaq 100 is Adobe, ADBE, Adobe Systems, and what stands out to me, you can see it circled here. We got a big old fat bearish engulfing candlestick. That's right here. It came, that's not an arrow tool. Here's an arrow tool. It came at the top of this price channel right here. You can see Adobe's in a price channel. We had a confirming red candle, just one so far, but what happened? We hit that. 2 green candles. On this one, because we've had 2 green candles, we're still above the top of the bearish engulfing. You could certainly have a short trade here. This one you might want to wait to see some downside, see the Qs break down, the FANG stock, see this channel break. So I'm lukewarm on it as a short trade. You could short it here, and I would have a stop just not far above that bearish engulfing. If they take that out, then that's not a good sign. What's interesting to note is you can see on going back here for a couple years, there have been 1, 2, 3 major corrections. Even the smallest one measured, just, on this chart, is 12% drop, and these others were quite a bit more, 15%, and then this one here, 34%. And what they all had in common, every single one of them, the previous, is same thing: bearish engulfing candlestick. There was your red confirming candle, a couple more confirming candles after a gap. Bearish engulfing right there, mark the top. We even had, this is interesting, back here, right here, if you zoom in on the video, that's a bearish engulfing, but you didn't have that. I always told you guys I like to see a confirming, at least one confirming red candle, and I like to say the redder the better. If you have 2, 3, 4 confirming red candles, that's even better, but you didn't have it there. So I would say this, bearish engulfing candles can come anywhere, even during an uptrend, and sometimes you just get them and the trend keeps going. So you didn't, that was not a sell signal, at least not my type of sell signal. This one was. You had that candle engulfed, followed by 1, 2, 3, 4 red candles, and so you could have shorted there on that second day with the red confirming candle and captured the bulk of that drop. Same thing here, big bearish engulfing, then engulfed the 2 previous green candles, gap down, so you even had an island top right there. Well, it was close to a gap. I'm not sure if it was, but you did have a follow-up confirming red candle. You had 1 green candle after that kicked up. Not too different from right here. We have 2 green candles, but actually today's not over, so we'll see where today's candle ends. It's green right now. But I just want to point out, bearish engulfing, confirming candle, and then that's how much we fell from there. So that's technical analysis. It's just looking at past patterns and playing the odds, and they all don't work out. But the thing about these, again, it's all risk reward. If you short something like this, expecting a possible top, and your stop is not far above, then you're risking just a minimal amount compared to the downside potential. Again, all double-digit corrections back then. And this one, because of where we are in the market cycle, the economy, the extreme divergence between the economic fundamentals and what the stock market's doing, a lot of these stocks like this, like Adobe, testing, by the way, worth mentioning, it's also testing it failed breakout to all-time highs right there. That bearish engulfing was a false breakout or failed breakout. And that's pretty bearish itself. So enough on that. Targets, I don't have them. I didn't mark all these charts up, but I would say, since you're looking at a major topping stick, at minimum right here 327. And if you shorted the stock here today, right now where we're at, if I can do this, somewhere around there, you're talking about a 14-15% drop. And again, that would be, let's just say, I don't want to call it my minimum target. I could give you a couple other targets here where I see some support. There you go. But let's just say right now, preferred swing target. Next up would be Netflix, because that's in the Nasdaq 100. We're already short this one. It's an active trade. We already hit our first target, came very close to our second target. I mentioned it yesterday as an objective short, because we had bounced back to resistance around where the first target was set, and it so far was rejected off there, not moving impulsively lower, but neither is the market. So still like this trade, and I'll continue to update it as long as it's an active trade. Next up, VRTX, Vertex Pharmaceuticals. Just kind of common stuff here. You can go back in time, see these divergent highs. You can find divergent lows. Breakout above this trend line here, this downtrend line, was a catalyst for this run. But here's the thing, there was our last divergent high, and that was good for a drop of about 20%. We have a divergent high here. We had a divergent high right here. We had one right there. Simple stuff. It's really not 100%, but play the odds, with divergent eye in this stock, and get to know the nature of your stock too. When this one, every stock is different. This sucker here has about on average, it drops about 20% after these divergent highs, even in a bull trend. Now imagine if the bull market's over, and because the S&P still hasn't made new highs, and a lot of these stocks that are at all-time highs then they will. This is what happens in a bear market. There's always the broad markets roll over, a lot of stocks start rolling over, and there's just fewer and fewer going higher. They play a violent game of catch up to the downside. So if you disagree with me that we're probably in a bear market with a lot more downside to come, at the very least you have these opportunities right here. I just showed you 1, 2, 3 of them, all of them 20%, just over 20% drop. So this one has only fallen since then about 13%, and it's had a nice kickback. So I'd view this one, like here's the kickback rally. We're right about that point. We had the initial drop. We kicked back about halfway. Both of these looked to be about close to 50% retracements. This one kicked back almost to that previous high. So I don't have a hard resistance level to short at. Sometimes I can see a great level, on a bounce back. So this one you're kind of taking a gut shot, but again, the reversal's already come. There was also a pretty, it wasn't a bearish engulfing, but a red candle. And I'd probably just use a tight stop on this one based on where the indexes are and everything else. There is some resistance right there, about 288.42. So I think a stop a little bit above that. If you want to put it above the previous high too, I mean, you're talking just a relatively small amount of money. Again, relative. Everything's relative. It might be in percentage terms a lot to you. That's about, well, actually, no, that level's only 2.5. So it's small in actual and relative terms. Relative, I'm talking to the drop, to the potential. If this one's going to drop, go down 20% or more, then I'll take that all day long. If it drops 25%, 2.5% stop loss is a 10-to-1 risk reward ratio. That's phenomenal. You don't get that in a lot of trades. Got to be careful with biotechs, but that's the one thing about them. I don't know Vertex's whole business model. And so in the biotechs, I always say, where some stocks, I'll just look at the chart and not even do any research on the fundamentals. Check biotechs, because if they have a big drug and a lot riding on a drug in clinical trials, and you're long the stock and it gaps down because it bad results in phase 2 study, trials or wherever they're at, or positive results if you're short, these suckers can gap. Now I look at Vertex, it hasn't had a history of gaps in a while. The last time it was gappy was over here. I don't know if that had to do with any drugs they were working on or earnings, because it could be 3 months apart. I just want to kind of throw that out there. I always take a little bit smaller position size, especially in the smaller biotechs, because those suckers can gap 50% or more in a day, and talk about getting wiped out if you're not responsible or not, using proper position sizing and all things like that. Because stops are no good when a stop loss orders are no good when a stock has an opening gap above or below that stop. So be careful with that. All right, Starbucks, SBUX, again, Nasdaq 100 component. What do I see on Starbucks? Simple stuff. Look for these divergent highs. You had a divergent high right there, and well, actually that divergent high from there, that point Starbucks fell, and this was long before COVID hit. The chart said Starbucks was going to correct. I had long-standing negative divergences that continued to build, and they finally played out starting on the high back on July 26, 2019. From there, before all said and done, the stock fell 50%, was chopped in half. What's happened since then? Well, one of the things that happened is along the way there, they took out this key uptrend line right here, had a breakdown back test, might have been highlighted at the time, and then big drop. Now, where we've come is pretty much full circle. You have this uptrend line here, you have negative divergence, and by the way, it's not always negative divergence. I'll point out these divergent lows, they're bullish. That's when you want to step in and go long. That was a bullish falling wedge right there, and that led to that nice rally in Starbucks there. But where we're at now, let's just talk about today. We have negative divergence. As I always say, negative divergence is not a sell signal. It's an indication that a trend change is likely. But with Starbucks, I'm watching it, and you want to see a solid breakdown. There's some support below. The ideal scenario, we don't always get what we want, but ideally a push up here to about 82 would do this. It would extend the divergences a little more, still keep them intact as long as it happened relatively soon, and as long as we didn't go much below that. That's resistance. So I would love to see a spike on Starbucks into the resistance at 82, especially if it happens right after the Qs break down and some of those market-leading FANG stocks. Probably not going to get it, but again, that would be an objective shorting area. It would stop somewhat above, and for the next leg down in Starbucks. No sell signals yet, and again, a little shy of resistance, although it is actually worth mentioning before I move on. It is actually at one resistance level. You have the key 200-day, it's right here. It's this red line right here. The red line, perfect support right there. Perfect support right there. Some stocks respect certain moving averages better than others, and that's where I'll put a higher weighting. You can see Starbucks kind of traded through the 200 simple, that blue line, but it was excellent support all the way up, and then when it broke right here, it didn't just limp around and cut on back through there. The bottom fell out of the stock once the 200 gave way. And then what happened the very first time it touched it? perfect kiss right here recently, and it was rejected hard. What happened? We're at it again. So there it is. Bullish if it can take that out with conviction, but not until unless 82 goes. But I do want to clarify what I said earlier. The stock is technically at resistance, and it's at a moving average resistance, more so than price resistance. And then price resistance isn't too far ahead. So on something like this, you could short here, and the 82 level is only about, it's less than 5% overhead. Or if you're bullish, you want to go long in a breakout of 82, and it may foil these divergences, and the stock may continue higher. But like everything else, it's in the broad market, not everything, but the broad market and in the majority of other stocks, it's in a bear market. What would start to call that into question? Well, obviously when it takes out those previous all-time highs, but there's a downtrend line forming as well, which may come into play as resistance. Next one up, SISV, Fiserv. Here's a long-term trend line right here. We had a brief, in that meltdown in fourth quarter of 2018, was it? Yep, right there. And we broke it again here, and we're back testing. We already back tested it once, and there's also a confluence of the 200 and 20-day moving averages right here. And you can see roll back for a while, and that's the blue and red lines here. You can see they do a really good job of defining bull markets in this stock. And bear trend, that was a bear market in the stock. It fell over 20% then, but then it recovered the 200 right here, both 200 days, and tested them again, broke them there, fell below, and they're back testing. So you have it back testing, this stock back testing both trend line resistance, or close to it now, and as well as at this point we're testing the 200-day simple moving average, the blue one. We're a little bit above the red one. And again, that's why I like to have them both up here. All right, so again, the point is objective short. I don't have targets on this. I would take the mindset that, look, just see what develops over the next few weeks, and if anyone does take any of these stocks that I haven't listed targets, and you want to, just let me know. Just post a request under this video, and I'll give you some more targets. There's one level right there. All right, AMD, chip maker, big one too. Let's color this line up because this is a very significant trend line. I think I have a price alert set on this trend line. Let's just make it purple. It's starting to look like a Christmas tree. I haven't updated all these levels. These were important levels I had before. This was a big one here, this 34, 84-ish, 35. We had the stock had been pushing up against that level and failing there, and finally broke out. So it's bullish until unless that level goes. If it falls back below there, this whole thing will be one big topping pattern here. But right now, divergences continue to build. Any new high soon will be any marginal new high will be a divergent high. So if it happens to kick up, and the stock rallies up another 14-15%, it's only going to extend these divergences. They will not. The stock will not take these divergences out anytime soon. If it goes up another 40-50% or continues to climb for months, yeah, the divergences will be taken out. But until and unless they are, my expectation is no different than it was back here with this divergent high, and back here with this divergent high. And again, sometimes they take a while, they build, and then they finally play out. This one resulted in a 53% drop. This one resulted in a 23% drop off the divergent high. This one right here, we had a divergent high before, and we dropped about 36%, and we hit that long-term trend line I colored up, as well as those key 200-day moving averages. And look how they all come in together now. So this is a, first of all, yeah, well, I was going to say a target if you wanted to, pull back, but it's also a big level to watch, because if AMD slices down through here, and it could be days, weeks, months from now. So what I do is I set price alerts, and I may forget about this stock for a while, and 3 months from now I may get an alert, and I look, and AMD has sliced through the that key uptrend line as well as the 200-day moving averages. Then that's a longer term powerful sell signal if and when that happens. So that's one to keep on your radar, and it's more of what I call a trade setup than an active or actionable trade. REGN, Regeneron, nice clean trend line, breakdown, back test. That's an objective short, but again, as I'm doing this video, these are components, and a lot of them are top heavy, pretty large weighted components in QQQ. You're going to need to see the Qs break down to really help the case for these. But if you just keep it simple and use that whole wash repeat thing, you can see here in Regeneron, the stuff works. Divergent low, rally. Actually, we can say rally to there or all the way there before we correct it. But even then, right here we had divergent high, correction. We almost had a divergent low, not there, not quite, but we had another divergent high, another correction. Big divergent low, big rally. Little divergent high, when I say little correction, this is a biotech stock. That quote unquote little correction back here in this bull trend was about 17%. So this is swing trading, and this is where I like to point out that in a bear market you can make money trading bullish breakouts, counter trend rallies. In a bear trend on a stock or anything else, just like you can trade these corrections, they're very profitable. And also to sidestep it, let's say you were in Regeneron back then, and pointed out these divergences. We probably had some trend lines. If I zoom in there, we could have drawn to give you the sell signal, or maybe a bearish candlestick pattern. Yeah, there was a bearish engulfing candlestick right there at the top, and that led to that big drop. So again, wash, rinse, repeat stuff. Here we are. So a lot of these stocks have bearish technical postures, and if and when the Qs break down, those market leading FANG stocks, these are some of my favorites to be in. Zoom, everybody, if you didn't know Zoom before, you know them now. Everybody, why is it not pulling up? Zoom Technologies, that's not it. Yeah, I wrote it down on my scratch pad as ZOOM, Zoom Video, but the symbol, the ticker is ZM. ZM, relatively new company. When you roll back and you see a chart and there's no trading history before another, for that period, that's when the company became public. Zoom Videos, well, no, does those video chats, which exploded. So here's the thing, okay? Let's use the logic that the stock market is right. People buying this rally are correct, and COVID's over, the worst is over. Where social distancing, stay at home, things are all gone. So then you'd have to say, well, Zoom, you're going to see things plummet. Everyone's going to go back to where we were. So if the market's around, so is Zoom. Wouldn't this, if you're expecting this stock to continue higher, wouldn't by that simple logic you expect that we're going to see more, another flare up in COVID, more stay at home, people working from home? So, again, it's not meshing with that from that fundamental perspective. The stock has doubled, since the whole COVID thing started, more than doubled even from here, from the February low when the market bottomed right before, around February. Yeah, this is about 150%, and so it's up quite a bit. Now, here's the thing. Fundamentally, I'm just talking fundamentally. Zoom does not have a lock or a patent on video conferencing. We all know that. They just happened to be kind of one of the big one, and everyone went to that. They had a lot of technical issues. I don't know if those have worked out or not, but I know that Microsoft, there's quite a few others out there, but Microsoft, I think I believe is aggressively trying to get into that market. And who has more money? Microsoft is one of only a few $trillion companies in the world. It is one of the most cash flush companies in the world. If Microsoft wants in on the video market, video conferencing market, as well as others that want a piece of this pie, because whether COVID's here to stay or not, there's going to be, that's I think going to be a good part of the future. I think so. Anyways, I'm going to say a lot of competition is going to come online. That's fundamentals, fundamental ramblings. Technically, here's a big rising wedge pattern with negative divergence. There's your trend line to watch. Break at that, and to be safe, break a little below 154 should bring the stock down here. First target is about 132, and easily I could see this one coming all the way back to test these highs. That's a very good support level, and that would be my preferred target, whether it takes 6 months or a year or 6 weeks to get there. I think the stock will come back down there eventually, and that's about $40. However, we're in an uptrend with no sell signals, so right now just kind of be a pot shot trade. So maybe best again to wait to see some solid sell signals in QQQ, and then to see where that one's trading, and maybe consider either a partial or a full position, again depending on where it's at technically. All right, a few more. We're almost done. I'm not going to get to the small cap stocks because I don't want this video to go too long. We'll do those in a separate one. eBay. I don't know if eBay has found the cure for COVID or something, but since the lows here, yeah, everything got knocked down well below where it should have been, but eBay's up 71%. To say the stock is overbought would be an understatement. Overbought in itself is not a sell signal, but it's a heads up. You know, when stock becomes overbought, I'm just circling the last overbought readings in the last several years. Do you want to be buying the stock? No. If anything, you want to start getting either tighten up your stops if you're long, and or looking for an objective short entry once you get those overbought conditions. You also have some divergence starting to form here on the PPO as well. Not crazy about this trend line because we don't have a lot of reactions, but a very steep uptrend like this, whether that's the right trend line or not. Oh, and by the way, there's eBay also challenging these previous highs right here. We had a couple reactions after that all-time high right there. So again, just simply a lot of hot air under this stock, and even a pullback, even just a correction should take that stock back here at about 41.45, and that would be about a 6% drop. Not one of my favorites, but again, I figured it was worth mentioning. And then a couple more AMAT, Applied Materials. This is one of the big semiconductor equipment, chip maker stocks. AMAT, KLC, which I'll get to in a second. But simple stuff. We had a big, very clear pattern on this one before. We had a beautiful, well-defined uptrend line. By well-defined, I mean just the number of reactions that you have on that trend line. You also had nice big divergences, and again, those divergences built. We had a little shot across the bow correction, but they continued to build just like they are doing on the Qs right now, and all those market-leading FANG stocks. And just like back here, we had divergent high. And again, I point out divergent highs, and I also point out divergent lows, which are bullish. So that's it. That's the big stuff. These are the major trends. They're not always marked by divergent highs and lows, but quite often they are. So if you were short anytime around or after that divergent high for a trend or swing trade, you've made a lot of money. If you covered your shorts and started looking to go long when you saw the divergences building down here, you made a lot of money. And if you started shorting or shorted sometime after, especially on a break of this trend line, you made a lot of money on that 45-50% drop. And right now, we don't have the divergence on the daily time frame, but we do have this wedge pattern here. And yeah, can't make a screaming case on this one, but I would just watch for a break of the trend line and that 52.71 level. I think that'll do the trick for AMAT. And then last but not least, another chip equipment maker stock, KLAC, and KLAC is challenging its previous all-time highs. That was a divergent high followed by a big drop. Same old stuff. Divergent high, 20% correction. Divergent high, 21% correction. Divergent high. From there, the stock didn't stop falling until it hit down here, about 35% or so. Watch, rinse, repeat. Look for the divergent low. Time to get out of your shorts and get long. Big rally there. Divergent high, big correction. You see, it's simple stuff. But this time on this one, unlike AMAT, we do have negative divergence. We have a little wedge forming here, pretty well-defined uptrend line, stock rallying into resistance. And so you could start scaling into position here. But as I said, these divergences could continue to build, but you know what, if I don't already have it, I'm going to set a price alert right now. I'm trying to grab this trend line and to give me a heads up, and maybe this one will become an active or an official trade. Set alert. There we go. All right, guys, I'm going to wrap it up here. I believe that is everything I wanted to cover. Yes, that's all those stocks in the Qs. And we'll wait and see. It's not going to happen. The breakdown won't happen this week. If it's going to happen, we'll have to look at next week. We're precariously close to those trend lines on all those market-leading FANG stocks. But as I like to say, support is sport until and less broken. Just because we're close doesn't mean we're going to break it. It means we can hit it. But the fact there are those divergences in place that have been building makes me think that it's a matter of time. And at this point, they're pretty stretched. I think it's imminent. So where I was looking for that breakdown earlier for this week, I'm still looking for it next week. All right, we'll wrap up here. This has been Randy Finney with Right Side of the Chart. Have a great weekend.